You're watching Investor's Guide on ET Now. Thank you so much for joining us. Remember, this is the show that tracks your portfolios and finds the perfect investment product for you, given what's available in the market. There's an email ID at the bottom of your screen where you can write to us and send us any questions you might have about your money. Let's get straight to this. On this show, if you're a 30-year-old who doesn't own a single investment product, we'll help you get started today. Our product review this week, we look at the ICICI Prudential Dynamic Fund. And we have the Managing Director of CIBIL to help us understand our credit ratings and our scores better and tell us how we can improve our credit ratings. Right on top of the show, of course, we shouldn't ignore the fact that the Finance Minister has been busy changing the way we invest and buy products over the last couple of weeks. There are some big changes that have been announced in the last 1 week that you should know about. Here's a quick wrap of everything that changed in our world last week.
The central government has had a busy couple of weeks. The cabinet has kept its foot on the pedal, announcing a steady stream of reforms, especially in the investment world. Here is a list of the biggest changes that impact us. The new pension scheme now has a new name and new charge structure. The national pension system earlier forced pension fund managers to charge a measly 0.0009% as fees to manage the assets. This has now been hiked to 0.25%. The low fees were put in place to make the product affordable for unorganized laborers trying to build a retirement fund. But it also meant managers and distributors didn't really have enough incentive to sell the scheme aggressively. With the changes in place, the scheme is now a more viable business opportunity for its agents. Also, the cabinet has now allowed foreign direct investment of up to 26% in the pension sector. The insurance sector also saw significant changes during the week. To start off, the cabinet has hiked the FDI cap in the sector to 49% from the earlier 26%. Banks will now be allowed to serve as insurance brokers. Until now, banks could sell insurance policies from only a single insurance company. They will now be allowed to sell insurance policies from several companies as long as they set up a broking arm for this purpose. Unfortunately, all good news comes with a caveat. The Cabinet's FDI allowances will need a final parliamentary approval before it can be implemented. So the fate of these reform measures hangs in the balance till the winter session of Parliament.
The biggest change there obviously was the new pension scheme, or we used to call it, it's now called the National Pension System. Of course, I'm going to bring in Dhirendra Kumar here. He's going to advise us on what we should do. Dhirendra, the National Pension System is now remarkably more expensive than it was a couple of months ago. But should this change anything? Is it still a solid product that's worth our money?
Oh, undoubtedly. New pension system, the National Pension System, the new name of this scheme has been attractive. Now it has become a little more expensive, but it still remains the cheapest among its class in India and internationally. I don't think you have such long-term savings product available with such great tax advantage and at such cost. But there was a real problem with the earlier minimal cost that nobody was interested in even serving an investor. If you wanted to get started, it was impossible to get started. There was absolutely no interest built into the economic model for somebody holding your hand. That, I think, should be addressed to a reasonable extent with this.
All right, so while it's more expensive, the National Pension System, or the NPS, is still an excellent product, so it does make sense to open that account today and start putting away some retirement money. Let's move on to our portfolio segment. 30-year-old Prashant is written in from Hyderabad. He tells us he has an income of 56,000 rupees. Dhirendra, he doesn't have a single investment product. So he has a lot of things that he's chalked out, like what he wants for his retirement, what he wants to invest for his child's future. Some money is going into his PPF, but he has nothing as far as an investment corpus is concerned. It's not too late for him to start off. Where would you recommend he starts off, and how can he take those first baby steps?
So I would say it's very important to follow the first few principles, which is invest regularly. Don't invest, you have 6 lakh rupees worth of savings in your account and you'll be tempted to participate, and in a rising market there'll be far greater temptation. Don't do that. Spread your investment over a period of time, more so because you are getting started for the first time. The other is, if you You're good that you have been able to articulate your goals very sharply, that this is the money, you need an allocation for your child's education, you need for your own retirement, things like that. So if you can slot them, have different separate portfolios to some extent, maybe similar funds, have some kind of mental allocation that of the 10,000 rupees going into this much is for this goal, this much is for this goal.
He has written in saying he has a very low risk appetite and he doesn't want too much exposure to the volatility of the equity markets. So this obviously we need to give him a portfolio that fits that risk profile. What would you recommend he start with among our portfolios?
I would say that, our stable growth portfolio or our conservative portfolio, that is a worst case scenario. That will be a huge compromise on return if he's investing for next 10 years. But if he sticks to his statement that he's absolutely risk averse, still he should take that conservative allocation because, and that is also not risk free in a sense that it will have 20 to 30% into fixed income and into equity.
All right, Prashant, Dhirendra, they're advising you to take up a little more risk if you can make yourself comfortable with it. If you can't, our conservative portfolio is on your screen right now. My personal advice, start as soon as possible. You've waited far too long already. Dhirendra, we have another question from 33-year-old Suresh, who writes in from Chennai. He tells us he invested in the Birla Sun Life Tax Relief 96 from 2007 to 2009. He tells us the fund or his investment is currently showing a 40% loss. He wants to know if he should exit that fund and what funds he should be investing in once he exits from that fund. What would you recommend he does? What's your view on this fund right now?
No, this has proved to be an extremely disappointing fund. It was, earlier a blockbuster, and this is a fund which has generated record amount of, profits and returns in its initial years. But, what we have seen in 2011 and in 2008, that this fund falls freely in a falling market. This fund in ordinary times does just as well, but in bad times it does far too poorly than most other funds in its category relative to index. So I would say that if you are through with the lock-in period, get out of this fund.
All right, so if you have a question for Dhirendra, remember there's an email ID at the bottom of the screen. Dhirendra is with us in our Delhi studio. It's time for our product review. And this week we're looking at the ICICI Prudential Dynamic Fund. It's an interesting fund that can change its asset allocation based on how the market is performing. We're going to find out if this is a fund for you in this market. Avan is here to first give us an introduction. Avan.
Every investor who puts his hard-earned money in a mutual fund is hoping his capital will not be eroded by market volatility. The ICICI Prudential Dynamic Fund has been designed to deal with this very fear of losing money in the equity markets. The fund has the flexibility to invest across large, mid and small cap stocks without any restrictions. It also has the flexibility to take cash calls as high as 35% of the portfolio, which relatively safeguards the capital from erosion during downturns. The strategy, however, can be a dampener if the markets were to take a sudden turnaround and move upwards, as redeployment of cash can take time. The fund has managed to consistently beat its benchmark and its category average with a comfortable margin for over 7 years. If you invested 1,000 rupees in this fund when it launched, you would have 11,213 rupees today. So should you be adding it to your portfolio? Let's find out.
Thanks, Avan. Dhirendra, this is a very, very interesting fund. It has a consistent track record, both long and short term. It's an impressive large and mid-cap fund that changes its color based on how the market is looking. Now, over the last 3 or 4 weeks, the markets have turned around drastically. This fund has not managed to get on top of that change. Do you think that given the way the fund functions, it will be able to show us the kind of returns it normally does?
Yes, this is actually a problem with the fund, that this fund is not supposed to change color, or be that tactical. Basically, depending on the outlook of the market, the fund will have, will change its complexion. So this fund has lot of things can change in this fund. One, the allocation itself. This fund can go substantially into fixed income if the need be. It has a provision. That apart, the equity orientation, the character of the equity portfolio can also undergo a change. If we are in a racy bull market, this fund can be heavily into a different kind of stocks than the value orientation which we have seen over the past 2-3 years, which has been, and the fund has been very well able to protect the downside. and participate or generate reasonable return even in a struggling market. So a lot of things, there are a lot of moving parts in this fund, but it is unlikely that, in a 4,000 crore fund, in a rupees 4,000 crore fund, a lot of things can actually be changed that rapidly and quickly to capitalize on a market movement of the kind we have seen over the past 2-3 months. That I don't think is the idea here.
When you reviewed this fund in April on this show, you gave it 5 stars. Now, looking at how it's performed over the last 6 to 8 months, where would you place it now? And would you recommend it as something that our investors should have in their portfolios?
I would say that if a fund manager, if an investor is making a choice of entrusting a sizable part of his money, I would give it a 5 star.
5 stars there for the ICICI Prudential Dynamic Fund on Investors Guide. Let's move on to our hold or sell segment. Chidananda has written in Dhirendra, he wants to build a retirement corpus of 1 crore rupees in 10 years and also put together another corpus of 25 lakh rupees for his daughter's marriage in 5 years. He wants to know which of these funds he should hold on to and which he should sell in order to meet those goals. I'm going to take them in groups because it's a very interesting portfolio. First up on his list, he has Fidelity Equity, HDFC Equity and HDFC Top 200. Now, between these three, does he need to have all three of them in the same portfolio?
Yes, he can, given the time frame, he can do without the HDFC Top 200. Likewise, he should be little alert about the Fidelity Equity because there is going to be change and he should just be watchful.
All right, the other funds on his list, Reliance Vision and Reliance Banking. Now, banking has been doing well over the last 3 or 4 weeks, but would you recommend he has a specific sector exposure in his portfolio? He has a 10-year horizon.
A portfolio like this, which has to be passively run and one is gradually investing, you should ideally avoid any sectoral fund or thematic fund, and for that reason you should keep away from this banking fund. Reliance Vision, for its poor performance, you should keep away.
The Morgan Stanley ACE Fund and Morgan Stanley Growth are the next on his list, Dhirendra. Between the two of them, would you recommend he hangs on to both?
Morgan Stanley ACE is an impressive fund and it's a very high quality fund and a relatively new fund. Morgan Stanley Growth Fund, I think it has been a long-term underperformer. There was a case at one point about 5 years back, 6 years back when it was listed, when it was available at a discount. Since then, no, not at all. It is a relatively, it's a poorly performing cousin of this fund, and one shouldn't have it.
Next on his list, Franklin India Prima Plus, Franklin India Blue Chip and Franklin India Flexi Cap. Of the three funds, we know Blue Chip and Prima Plus are very impressive, but can he notch down the number of funds he has in his portfolio? Would you recommend he hangs on to all three?
No, I think he should do only with, he should just be with Franklin Prima Plus. Because Prima Plus is about 60% Blue Chip and 40% Prima, which is a mid-cap allocation. So he's getting all of it in a neat package, easy to monitor, and credible performance history, more consistent performance. So he can do without, Franklin Flexi Cap as well as Franklin Blue Chip.
All right, last in his list is Reliance Gold Savings. Now, he hasn't told us how much he's putting in this fund, Dhirendra, but would you like to give him a ceiling on that gold investment, maybe 5 or 10% of his total portfolio?
Given that, goal, an Indian investor's goal and accumulating a daughter's wedding and accumulating your savings and being able to ride the gold prices, it might be a good idea. If you're thinking in terms of exchanging it with a gold, a real gold, 10 years from now, and then converting it into jewelry, that's fine. But if it is an opportunistic thing, if he has just, getting carried by the recent momentum in gold prices, that's a very dangerous thing. He should do with checks and balances. He should have his stop loss. He should have his profit goals, and he should be disciplined about it.
Chidananda, that's your portfolio looked at by Dhirendra Kumar. Arun Tukral, the Managing Director of the Credit Information Bureau of India, or CIBIL as we all know it, joins us in this leg of the show to help us understand our credit rating better. Arun, it's always a pleasure to have you in the studio. Thank you so much for spending time with us. We have plenty of questions for you, which is classic. Every time you come into the studio, we are flooded with questions. But I want to ask you first about some changes we've noticed at CIBIL. Apparently, you have made an announcement that you've modified the manner in which scores are being calculated right now. Tell us what has changed and how it will impact our credit scores.
You see, it's not changed as such, but we have come out with a version 2, which we believe, was necessary because this score is now a few years old, and over a period of time, the consumer behavior has changed. The landscape is changing, It's in a changing and dynamic environment, market environment. So therefore, we felt that now we need to re-collaborate the score.
If I was someone, say, with an 800-point credit score up till now, under the new format, how does that change? Have you changed the weightage on something?
Yeah, the biggest advantage of the new score is, earlier, if you didn't have a history of 6 months, we couldn't score. Though our score band still remains 300 to 900. And obviously, the higher the score, the less the risk is shared with that transaction. Today, we have come out with the algorithm, with our new formula is that we can actually even give you a risk index for people who have a history which is less than 6 months.
We know that the two loans that people plan a lot in advance, maybe a year or two in advance, are either education loans or home loans, where you know that I'm going to borrow in the next year and a half, I'm going to borrow in the next 2 years. Given the changes that you've made in the new version, if I'm someone who's going to borrow over the next couple of years, can I do something to clean up my credit portfolio?
Yeah, absolutely. Absolutely. As I said, the score is a dynamic number. So it totally depends on your credit history and your payment behavior. If you have actually taken any loan, let's say a personal loan or an education loan for that matter, and you have gone delinquent, so over a period of time, obviously, there'll be an area of concern and your score could go lower. And you see, if going forward your history improves and your discipline is there and you're paying your EMIs regularly, then your score will gradually go up. So that helps. But I will also advise you that before you go for a loan, you must access your report, see the report so that you see the same picture which a bank, once you apply, would see. And if there are any discrepancies or if there is a delinquent, you should be able to address that before you go in and apply for a loan.
All right, details on how you can access your credit report are on your screen right now. You can jot that down. Arun, tell me something. When you say it depends on your credit history, does it make a difference the kind of loans that I have? If I'm someone who has 5 credit cards, vis-a-vis someone who has a running auto loan, 1 credit card, 1 personal loan, does that make a difference to the score?
Yeah, absolutely. You see, if you have a healthy mix of both secured and unsecured loans, so if you have a combination of that, that's a healthy mix, and we understand that, and your score would have a different connotation and the impact, and your score should be higher than if you have, let's say, 5 or 6 credit cards, as you said.
We have questions, as we always do, for you, Arun.
Sure.
Ravi has written in. He tells us his father has taken a personal loan 3 years ago, did not repay it on time. He now wants to take an education loan. He wants to know, he hasn't told us if his father is going to be a guarantor on that loan, but he wants to know if his father's credit history will have any impact on him.
If you are taking a loan on your name, and it is not, earlier loan was only in your father's name, then it will not have any impact, because we don't show one person's history or one person's loan in another. Then it's purely individual. But yes, if you had taken a joint account and it was joint loan,
if the loan that was
obviously
defaulted on was a joint loan,
yeah, and if it's gone delinquent, then it will be part of your report also.
Question from Kiran, who tells us he had an outstanding of 55,000 rupees on his Axis Bank credit card. He tells us he couldn't repay it completely because he lost his job, but he did settle it for 17,000 rupees. He now says his name has appeared on the CIBIL list, which obviously means that there's a default against his record. And he's not allowed now to be a co-applicant on his brother's education loan, which is a similar question. He wants to know what can he do now to improve that situation.
If somebody accesses your report, it will have a column which would be settled, which would obviously be considered by the bank where you apply. So that would be, so what you should be doing, as I first said, one, you should definitely start taking your report and the score so that you know what you have and what is the kind of picture you're going to have there when the bank accesses the report. But definitely, if it's settled, the banks would have, certain banks do have a policy where they would like to consider and not give you a loan, which is a challenge.
Geeta Sharma has written in, she wants to know the difference between a settled status and a zero status, which you've explained to us. So tell us this, for someone who's watching at home, who possibly has the default on their book, on their record right now, would you recommend paying it off in full instead of settling with the bank?
If you have zero balance, there is no reason your score and history would be impacted, because if you've settled finally and paid up, it will show zero balance, which would really benefit you. So whenever you are also settling down for whatever reason, you should pay fully and not pay part of it, because that will be reflected in your report whenever it's accessed by any credit grant.
S.N. Tiwari has written in, he tells us there's a problem with his record. It says that he hasn't paid his credit card dues on time, but he claims that he has. So obviously there's an error. So what should he do to fix that?
All the credit grantors, that's all financial institutions, share their data with CIBIL on a monthly basis. But as I said, you can actually access your report and look at it and look at the score. And if they haven't done it, you can contact the concerned credit grantor or come to CIBIL, and we have a dispute resolution it's on the website. You just fill the form, you're giving your name, ID, control number, date of birth, and we will take it up with the concerned credit grantor and see to it that it's resolved. And in the next monthly cycle, when the data is given to CIBIL, we will update the record and a new report would be generated.
We know for those people who've maintained really good credit scores, are we close to a point where banks start rewarding them with lower interest rates perhaps?
Definitely would help that our score is good and you are entertained and will be able to negotiate with the bank and get better, the terms and conditions. People are not paying processing. In home loans, I know for a fact, which was a big thing, the processing is not being paid, and if they always go and negotiate, if I'm going to be paying X, I can get -X with somebody, so therefore if you don't give it, I'm going. So if he's a good customer and the bank wants to retain him, there's no reason that they would not like to do that.
So if you have a really good score, which is 800 and above, then negotiate with the bank to drop the processing charges altogether on your home loan, like Arun tells us. Thank you so much. That's a very interesting tip. Thank you for spending time with us as well.
Thank you so much.